Hi, I'm Jack, and welcome to the Attract Capital webinar series. Today I'm here with Attract Capital CEO and founder David Barnett.
Hello, everybody.
Today, our webinar title is What are Basic Mezzanine Debt Terms? So, Dave, first describe mezzanine debt, and then how is it different than a bank loan?
Sure, Jack. Great question. So, mezzanine debt is a cash flow based financing that's based on the adjusted EBITDA of the company. It's a multiple of the adjusted EBITDA, which makes it very different than a bank loan because a bank loan is based on hard assets and the collateral value of a company. And unlike a bank loan, you don't have to pay off the principal on an annual basis. The principal is back-ended. And because it's based on EBITDA and adjusted EBITDA, it usually means that it's a much larger loan amount that you can get from a bank. So it has a much larger quantum of capital associated with it than a bank loan would.
And can you please describe the conditions of the mezzanine debt market today?
So the mezzanine debt market is very strong. A lot of the mezzanine debt lenders are flush with capital. They've raised new funds. They have adopted a direct lending approach where they're looking to lend directly to companies and not just focus on private equity buyouts. You have a lot of multi-strategy asset platforms that are getting into the mezzanine debt and looking to increase their exposure to the middle market. They're a bit more defensive now, Jack, than they were a year ago. They're looking for counter-cyclical, staple type industries such as healthcare, such as IT, pharma, food that will continue to do well in a recession. And because there's so much capital, these lenders are having to compete and they're having to be more innovative in the structures and in the value that they offer their borrowers.
And can you run through the major basic terms for mezzanine debt?
Sure. So a mezzanine loan is generally 5 to 6 years. Unlike a bank loan, you only pay it off in a balloon at the end. So you pay 100% of the loan off at the 5 or 6 year maturity date. You can prepay it earlier if you have a lot of cash. And if you have used the money and you've taken your large growth step and you don't need that to pay the higher interest rate any longer, then you should just do that. But essentially, it allows you to have a much longer term to repay the loan, which allows you to utilize the excess cash that you generate. It is also never, unlike a bank loan, personally guaranteed. Mezzanine lenders look to the credit worthiness of the borrower as determined through the stability of the cash flow to be able to service the debt. So they don't care about the net worth of the owner of the company. They only care about the credit worthiness of the company that they're lending to. Usually, mezzanine debt is priced in the 14 to 16% range. There can be special situations that would result in deviations from that range, but by and large, it's a 14 to 16% all in return on an annual basis that the company will have to pay. The loan size is expressed as a multiple of the adjusted EBITDA. That multiple range varies on the risk of each deal and on the industry, but it is generally in the 3 to 4 times range. So if you have 3 million of EBITDA, your total debt range can be anywhere from 9 million to 12 million if it's a 3 to 4 multiple range. And in terms of its security position, it is a subordinated loan, which means that it's junior and it is in a second lien position to any senior debt or bank debt that is in the company. So it is largely unsecured. So in a downside or in a liquidation scenario, the mezzanine debt lender really has a very dim chance for full recovery of their loan amount.
So what situations are best for mezzanine debt?
So the situations that are best for mezzanine debt are situations where there's a big change that the company can take advantage of. Something where there's a transformation or there's a very large step that the business wants to take. Like for example, an acquisition. They want to acquire another company. A bank's not going to finance the acquisition of another company because usually the price is going to be well beyond the asset base of the target company. So the mezzanine lender can finance an acquisition, which will ultimately end up being transformative and really expand the value of the company that's buying it. Also, transitional internal growth. So if you are a distributor and you want to become sort of a product-based company, or if you're a domestic distributor and you want to start internationally distributing, or if you want to add another level of vertical integration to your company, there's tremendous value of bringing in a mezzanine lender to invest in your business so that you can grow at a faster organic rate a lot of times we refer to this, Jack, as like hypergrowth. So if you have a hypergrowth scenario, you can really take advantage of that. And I would say hypergrowth includes regional expansion, new product, new capacity, pretty much any sort of a significant growth step. So whether it's acquisition or aggressive internal growth, mezzanine debt is great for it.
Well, there you have it. Thanks for tuning in, and we look forward to seeing you next time on the Attract Capital webinar series.
Take care.